Answer this simple question for me. Would you rather have A, 100% certainty to win $100, or B, a 50-50 chance to win $200 or nothing at all? While you think about that, I want to start with risk and risk management because you simply can't get rid of risk. It's everywhere. Therefore, risk taking has to occur no matter what. But how much? Well, that's up to you. Okay, well, what about the reward? Well, that's not always up to you. I'm trying to highlight this often overlooked relationship between risk and reward, which is what the first question was about. About 80% of you would simply choose option A because it's a guaranteed win. I realize some of my gamblers and even risk takers out there might choose option B, but I can fix that by simply changing the dollar amount. Same question, but different amounts. Option A, would you take 100% certainty to win $1 million? Or option B, have a 50-50 chance to win $2 million or nothing at all? What I'm teasing out is this concept of risk appetite, which is the amount of risk an investor is willing to accept or take in order to receive a reward. It then becomes logical that everyone would choose option A and take the guaranteed $1 million. One more question. What would you choose? 100% certainty to lose $100, or B, a 50-50 chance to lose $200 or maybe nothing at all? What these questions reveal in general, and again, I repeat, in general, is that we tend to go for the certainty when we can win something, like in the first question, and then we tend to gamble more when it's about what we're going to potentially lose. Your individual risk appetite itself is more of a mix of being risk averse and risk taker. Risk averse investors are more willing to accept lower levels of risk, even though it comes with lower returns, while the risk taker is willing to accept higher levels of risk, seeking higher levels of reward. This concept has led to the creation of a number of risk-reward matrices as well as impact and probability matrices, and they're all basically aimed at helping people understand risk and reward. Unfortunately, these representations make it seem like risk and reward can be plotted on a chart with a straight diagonal line, implying a one-to-one relationship between risk and reward, meaning a 1 unit increase in risk results in a 1 unit increase in reward. That just isn't the case for most of the situations, and especially when it comes to investing. In reality, it looks more like an arc-shaped line, with risk being along the x-axis and reward being along the y-axis. Notice that at the beginning of the chart, you see a decent return with relatively little risk. Notice how the slope for your reward starts to decrease as you increase your risk, or as risk increases. Look at the next slide, which plots some of the main investment vehicles, and hopefully this will start to make more sense. Here you can see cash almost has no risk, but also has no return. Then we see fixed interest or fixed income investments, then property and real estate. And you can see that real estate gives you a nice return relative to the level of risk. And after that, shares and alternative assets. And as you move from property to alternative assets, the slope of that line tells us that for the little extra return you get, you actually are taking far more risk. Here's another example that is specific to stocks, and it's basically the same concept. I share this because too often, especially new investors, they believe that in order to get big gains, you have to take on big risk. And while on the surface that seems correct, especially when you think about it as risk reward being a linear relationship, even though it's not, instead, I want you to see and understand that there are kind of two places that are really key on this chart. One is on the far left, where you can receive a higher reward proportionate to the level of risk, and conversely, at the far end, where you can assume a higher proportion of risk for not that comparable level of reward. I don't want you to fall into this trap thinking that you have to take extreme risks in order to have really good returns. Instead, I want you to think about finding that sweet spot between maximizing your reward for the risk and that one-to-one ratio of risk and reward, because that is where you really want to live as an investor. This is critical because as stackers, we tend to almost hyper-focus on metals, and that's because it's truly one of the smartest things we can do with our money, and it provides wonderful level of reward for the risk, as in reality, it's not a very risky investment in my opinion. At the same time, it can't be our only asset because it's awfully close to trying to save your way into wealth, and that just doesn't really happen. The reality is that we need some of those investments that provide higher level of returns or even leverage returns in order for us to grow our wealth, which is why you frequently hear me discuss investing in mining stocks as well as real estate stocks and businesses, because those are all a part of the stacker's wealth pyramid. And yes, risk increases with these investments, but so does reward. The key is finding the sweet spot I mentioned, and I want you to keep this chart and you take a screenshot or a Google Lens of it or whatever, because it will help serve as a way to help you conceptualize your overall financial portfolio and the level of risk and reward associated with it. I do plan to cover portfolio management at some time, but until then, I want you to apply all your investments along this diagram to help you get a sense of how your portfolio is currently structured. Obviously, for my retired or near retirement folks, you probably should be more on the left-hand side, and my 20-year-olds should probably be more on the right side. Either way, just seeing where your money is allocated can be very eye-opening. Bringing it back to stacking and physical metals in particular as our base approach, we have to at least consider the other ways to make money related to gold and silver and even other commodities like copper and lithium. While this chart plots the different types of stock funds, it can still serve as a guide for us for how we would plot metal-related investments. As an example, I did a little table to show you the type of investment and the risk level. Your chart may look different, and that's okay. What matters is that you are developing your approach, as I want you to have a framework. Again, this is so important because I know and I see so many people taking on far more risk than they have to, thinking that that is how you make money as an investor. For me, investing is about controlled aggression, almost like being a boxer. You just don't run out there and throw punches or throw your money around. Boxers, they move inside their opponent's defenses. They throw their punches with force and accuracy while maintaining a proper defensive posture to protect themselves. They have to be disciplined and punch when the time is right. They have to stay patient, waiting for the right moment to strike while minimizing unnecessary risk. That is what I want you to think like and act like as an investor. Take your shots, but do it under control while still protecting yourself. I can't tell you all what to do, but for me, that looks a lot like large amount of physical metals and mining stocks, but it's a mix of major and junior miner stocks and a small number of explorers. As I've shared during our last training on our Discord channel, you should check that out. You don't need a team of home run hitters because they also strike out a lot. You need a team or a portfolio with players or stocks that hit singles, doubles, and triples because they bring in runs as well. You don't need a portfolio of stocks that have potential 10-baggers because not every one of those companies is actually going to turn out to be a 10-bagger. There's nothing wrong with a portfolio of 3 or 4 or 5-baggers that give you a solid return without the additional risk. You absolutely can have some investments or companies that are on the farther end of the curve, but make sure it's balanced out with those other solid companies that have lower risk. I'm going to give you the questions for the comment section a little early. In the comment section, what is your risk appetite? Are you more risk averse or more of a risk taker? Is your current portfolio low, medium, or high level of risk? And would you like for me to do a full video on portfolio management? Or simply put an A+ in the grade book comment section because we know in a few weeks, grades will be coming out. I did the comment section early this time because last week USGO asked me and a number of other creators, I'm sure you saw them, to do a sponsored video discussing the company. As I shared back then, I was totally on board because it was a stock I'd already owned and I was very familiar with the company. Believe it or not, I only bring you companies that either I own or would seriously consider owning. And of course, I always disclose if I do own them. At any rate, I did the video and moved on. A few days ago, they reached out again and asked me if I would do another quick explanation of the company to make sure people are more than aware. I said yes, but I thought it was a little odd. I mean, we just covered them and I think I did a great job if I can say so for myself, but it got me thinking, why would they have me and other creators do another video so soon? I'm going to give you my speculation in a few moments, so just hold tight. As I shared in my table earlier, explorers are definitely high risk with high reward, and depending on where they are in the exploration cycle, that risk can be managed. That's one of the reasons why I bought the stock a little while ago and why my boy, the check stacker, got in on the IPO at $9, but he didn't remind me to buy it. I'm not bitter or anything. I mean, it's not every day a mining stock hits the market at $9 and goes to 15 almost right away. Nope, not bitter at all. I see you, check stacker. What makes USGO mining special, to me at least, is that they already know what they have. Their Whistler project contains 9.4 million equivalent resources or ounces, which is 3.4 measured and 6 million inferred, which means they aren't like most explorers running around drilling holes, trying to determine what they have and burning through cash. In fact, unlike most explorers, USGO Mining is sitting on $20 million in cash, which is almost unheard of for an explorer. With Gold Mining Inc. owning 80% of the company, I speculated last night that something was up. Because why would gold mining spin off such a valuable project? I mean, with a market cap of $180 million, $20 million in the bank, and a potential value of $500 to over $1 billion based on the number of ounces and whether or not they are receiving $40 or $50 per ounce? Unfortunately, I don't have Amir Adnani's cell phone number, and heck, I'm not even sure he would tell me if I called him. So why wouldn't Gold Mining Inc. just keep this property for themselves? With some of the best leaders in the industry at Gold Mining Inc., there had to be a reason. Why would Tim Scott leave his incredible job at Newmont to become US Gold Mining CEO? As you can see, I have a lot of unanswered questions. So if anyone has Amir's cell phone number, shoot me a message and I'll definitely try to holler at him. Without anyone to answer my questions, I'm left to speculate. So I want to be clear, this is me just trying to read the tea leaves. First and foremost, there has to be something good, in my opinion, going on with the company if they're already sitting on $20 million in cash, still raising money like crazy, and advertising through creators on YouTube. In the mining world, there are only a few plausible reasons to start building a mine, to buy someone else out, or to be bought out, all of which should be very good for stockholders. Also, I did a little Google search and found multiple articles about several mining companies being added to either the Russell 3000 or the Russell 2000 index just last week. Ultimately, what I just shared are my crazy little thoughts from a faceless dude on YouTube. So definitely you shouldn't take this advice and you should do your own research as I did. But what I do know is USGO Mining is an incredibly solid company. I know that there is an energy and a buzz that I haven't really seen before, and that intrigues me. As I shared earlier, we have to assess the risk reward of every investment. And even within that, we still have ways to manage our risk. In the case of USGO Mining, some of the risk of them being an explorer has and can be managed when the company has great leadership, a gigantic deposit, and somewhere around $20 million in cash. Risk can be avoided, it can be managed. And when you take on risk, that reward must be in balance. Always stack smarter, never stop learning.